back to JPX Energy Market Weekly Updates. Last week, global LNG market focus was on the United States, as U.S. natural gas benchmark prices jumped to about $9 per million British thermal hits. Record LNG export combined with unseasonably high demand for electricity in recent weeks have pushed U.S. natural gas prices considerably higher than they normally are at this time of year. Moreover, working natural gas stocks are around 18% lower than year-ago level and 15% lower than the 5-year average for the past week, according to the EIA latest weekly report released on May the 26th. The report also estimated a net injection of just 16 billion cubic feet in the South Central region during the prior week, with South Kevin's cross-region showing net zero change in storage levels for the period. Already depleted gas storage inventories in the South Central region face outsized market risk this summer, with strong power burns, narrow summer to winter forward price spreads, and record LNG demand promising to slow injections. In 2001, incremental LNG supply from the United States accounted for more than a total of global LNG incremental supply. Australia and Qatar are still leading the pack with 78.5 million tons and 77 million tons respectively, followed by the United States, who supplies 67 million tons of LNG in 2021 and could become the world's leading LNG supplier this year. U.S. natural gas prices have surged more than 130% since the beginning of this year due to strong demand for LNG, especially in Europe, which is scrambling to replace as much Russian gas soon as possible. Even so, the U.S. natural gas prices are significantly lower than Asian or European prices. As export increase, the U.S. natural gas prices is likely to stay elevated for the rest of the year. Key demand centers in Europe and Asia are facing their own set of uncertainties ahead of next winter, the peak demand period in Northern Hemisphere. In European gas market, attention previously focused on Russia, as Russian President signed a decree requiring European buyers of Russian natural gas to transfer funds in rubles. The impact is basically diminished, with most countries reaching a compromise. Although countries that refuse to comply with the new mechanism, including Poland, Bulgaria, and Finland, have been cut off from Russian supplies, the overall impact in the European market seems small. At the same time, the European Commission and the United States reaffirmed on May 24th the need to take decisive action to cut Russian energy imports. The move triggered renewed supply-side concerns, with the European gas prices remain high and volatile. Since the outbreak of Russia and Ukraine war, Europe has become the world premier LNG market. On the one hand, high gas prices are set away on gas demand in the power and industrial sectors. European natural gas demand is forecast to decline by close to 6% in 2022 by the IEA. On the other hand, Europe has imported record LNG volumes of 14 to 15% per month so far in 2022 by attracting most spot cargoes available with a price premium to Asian buyers offered. European gas storage injections hit their highs on record for the May to May period this year, slightly above the 2020 levels. The strong storage injections have moderated down Europe's storage deficit, with inventory levels now standing just 9% below their 5-year average. With so many LNG cargoes shipped to Europe, the ability to land those cargoes at European port facilities become more challenging. LNG vessels are seen built up outside the ports of northwest Europe in recent weeks. Even so, for the rest of the year, as Europe gradually cuts Russian supplies, the Dutch TTF prices may still remain a premium level to other markets to track spot LNG cargoes. Injections are probably driven by two factors: storage regulations and field targets. Germany, for example, under the new rules, operators must fill the storage facilities to 90% of capacity by November 1st. Secondly, potential supply risk ahead of next winter. In Asian LNG market, benchmark JKM prices until recently have generally been at a premium to Atlantic Basin prices, so Europe acted as the market of last resort for LNG cargoes. But the aperture has flipped this year, with Asian prices instead tracking European hub prices. High spot LNG prices are hurting importers across Asia. Asian LNG imports fell 10% year-on-year in the first quarter of this year, with Chinese, Japanese, and Indian imports down 11%, 14%, and 25% respectively. In April, JKM prices below 30, and in the first half of May, spot prices for June delivery cargoes dipped below 20 on some days as European LNG terminals lost filled up. Prices will need to drop below 20 to incentivize buyers to return to the market, according to what traders and industry executives said at the World Gas Conference. While the spread of TTF front-month contract and JKM price has narrowed, Europe is still offering a premium on forward contract for the remainder of the year that indicates the competition between Europe and Asia for limited LNG will be intense for the following month. Okay, that's all I would like to share with you this week. For more information on the energy market, please stay tuned for JPX Energy Market Weekly Updates.